Imagine waking up 2 years from now, opening your brokerage app, and realizing that the money you invested has quietly been paying you every single month. No day trading, no crypto panic, just good old-fashioned cash flow rolling in while you were busy living your life. Sounds dreamy, right? Let's rewind the clock a little. It's 2 years ago, and you've got a fresh $20,000 sitting in your savings account. You're ready to make that money work. You spent hours watching YouTube videos and reading Reddit threads. One name keeps popping up: SCHD. And right next to it, JEPI. They're like the Batman and Robin of the Dividend ETF world. Batman, SCHD, is the calm, disciplined type, while Robin, JEPI, is the flashy, fun sidekick handing you cash every month. You decide to split your $20,000 in half. 10 grand goes into each, and thus begins one of the most satisfying investment experiments of your life. If you've ever invested before, you know that initial mix of excitement and mild nausea. You hit buy, and suddenly you own 130 to 140 shares of SCHD. We're talking about a basket of reliable dividend-paying companies like Pepsi and Home Depot that thrive even during recessions. Then comes JEPI, the monthly money printer, around $55 a share for roughly 181 shares from your 10 grand. CHD is like planting a tree. JEPI, it's like adopting a goose that lays golden eggs every month. In the first few months, SCHD drops quarterly dividend checks of around $100, while JEPI gives you mini celebrations each month. Before long, you start treating those payouts like celebrations, buying lattes or reinvesting every penny. It feels rewarding. Isn't JEPI too good to be true? A yield of 8 to 10% sounds suspicious, but its secret sauce isn't magic, it's covered calls. They sell options to generate extra income and pass that on to you. The trade-off? No explosive price growth. You won't see doubling overnight. Fast forward to year one, SCHD paid you around $400 in dividends, while JEPI, almost $900, more than double the cash flow. It's addictive and consistent. Your money is actually working, providing regular income. Team JEPI is high-fiving over monthly payouts, while Team SCHD appreciates their gradually rising share price. Both are winning. Then October 2024 rolls around, and SCHD drops a little surprise, a 3-for-1 stock split. One day, you own about 140 shares. The next, you've got 420. Your account suddenly looks like it's been hitting the gym. Of course, nothing's technically changed. The share price is lower, but the total value is the same. Your payout per share drops too, but because you have more shares, the total income stays roughly the same. It's all psychological. But hey, psychology matters in investing. Suddenly, SCHD feels more affordable to new investors, and that often fuels demand down the road. As the months tick by, JEPI keeps humming along, reliably dropping $70 to $80 a month into your account like clockwork. By the end of the second year, that's another $900, bringing your total to over $1,700 in payouts. Meanwhile, SCHD's price has likely crept up a bit. Maybe your original $10,000 is now worth around $11,000 or more, plus the $800 you pocketed in dividends. And this is where you have a moment. You look at your account and realize that you've been paid over $2,500 just for holding these two ETFs. You didn't chase meme stocks. You didn't try to time the market. You didn't even think about it most days. You simply set it, forgot it, and let time do the heavy lifting. Investing, if you do it right, stops being about numbers and starts being about psychology. SCHD's quarterly payouts feel like seasonal bonuses, slow, steady, predictable, always trending upward. JEPI's monthly payouts become part of your rhythm, reminding you that you're building something. Reinvesting is the closest thing to financial magic we have. It grows your wealth through compounding. 2 years in, you're already seeing momentum. Imagine what happens in a decade with SCHD's 7% growth. SCHD's dividend checks are fatter than ever, pushing $900 a year, and that's without you doing anything fancy. JEPI? It's been sending you consistent cash every single month, enough to cover groceries, subscription bills, or the occasional impulse vacation. When the market drops, you don't panic. You see opportunity. SCHD's dividends keep rolling in. JEPI's monthly income doesn't miss a beat. Imagine holding both SCHD and JEPI for 20 years. SCHD's payouts could exceed $2,000 a year. JEPI's cumulative income might top $20,000. Reinvest all of it, and your total wealth isn't just growing. It's snowballing into something substantial. Say you'd continued reinvesting all your payouts from both funds. That original $20,000 might now be $80,000, $100,000, or maybe more. Instead of $800 or $900 a year, you could be pocketing several $1,000s annually without adding another penny of your own money. If you've built a $500,000 position split evenly between SCHD and JEPI, you're looking at $30,000 to $40,000 in annual passive income. You don't have to sell a single share to get it. That means your capital keeps growing even as it pays you. Imagine getting a paycheck every month from JEPI, enough to cover rent, groceries, or travel. And every quarter, SCHD drops a larger, fatter check into your account, covering healthcare, insurance, or vacations. Nothing in investing is guaranteed, and pretending otherwise sets you up for disappointment. JEPI's covered call strategy means its payouts can fluctuate with market conditions. Some months, the income might dip. SCHD's dividend growth depends on the health of underlying companies. If corporate America sneezes, your payouts might catch a cold. When you hold both, they balance each other out. JEPI softens the blow during market dips with reliable income. SCHD provides growth and upside when times are good. Investing isn't just math, it's deeply emotional. Early on, volatility feels personal. A 3% dip feels like a failure. But when you're getting paid every month, market swings start to feel like background noise. They become opportunities. This shift in mindset might be the most underrated part of dividend investing. The consistent income stream rewires your brain. It stops you from panic selling. It keeps you focused on the long game. And it gives you something most investors never find: peace of mind. When you know that money is going to land in your account every month, it changes how you think about risk. Market dips don't feel like disasters. Instead, you start asking yourself how many additional shares you can scoop up on sale. Your time horizon naturally extends. Even a small payout becomes a reminder that your money is alive and working for you, building confidence, discipline, and patience. That peace of mind has ripple effects. you might stop obsessing over stock charts and focus on lifestyle design instead. This is what people mean when they talk about financial freedom. Options. The option to say no, slow down, and build a life on your terms. The principles are the same whether you're starting with $500 or $50,000. The key is time. Dividend investing is like planting a tree. The sooner you start, the sooner you sit in the shade. Consider investing $200 a month into SCHD and JEPI. That's $100 into each. You'd have $2,400 invested after the first year. But here's where most people underestimate investing. It's not about the size of the first step. It's about the fact that you took it. Stick with that habit for 5 years. Reinvest every payout and watch your investment transform. Those monthly JEPI payouts, they're buying extra shares every time they hit your account. Fast forward 10 years, and suddenly that small $200 habit could have snowballed into tens of thousands of dollars. This portfolio might now generate hundreds, maybe even thousands, in annual income on its own. And here's the best part. You didn't have to time the market perfectly. It's about pairing ETFs. SCHD for dividend growth and capital appreciation. JEPI for reliable cash flow. Together, they complement each other's strengths and cover weaknesses, enhancing your portfolio's performance. CHD's dividends rise while JEP provides income, making investing feel strategic. The longer you stay invested, the more this strategy reshapes your relationship with money. You stop chasing the next hot stock tip. You stop panicking when the market dips 10%. Instead, you focus on what matters: time in the market, consistent reinvestment, and a portfolio that builds wealth quietly. That's how fortunes are built, with patience, discipline, and a plan. Let's peek even further down the road. In your 20s or 30s now, starting with a modest investment, fast forward 30 or 40 years. Those small contributions and reinvested dividends could grow into a 7-figure portfolio. It's a lifestyle, retirement on your terms. If starting later in life, focus more on the income side. JEPI's monthly payouts help cover expenses. CHD's dividends hedge against inflation, ensuring your income grows with your cost of living. They give you flexibility, the ability to pivot, adapt, and make choices without fear. The winner is the person who stays invested, the one who doesn't sell at the first dip. Wealth isn't built in weeks, it's built over decades. You don't need to pick sides between growth and income. You can have both. Let SCHDs build your long-term wealth, while JEPI pays you in the short term, creating a sustainable portfolio. Enjoy the journey and appreciate every payout. It's about the rush seeing the dividend received notification. Watch your wealth grow in practice, knowing your money works harder than you do. So here's my challenge to you. Stop waiting for the perfect time to invest. Stop trying to predict the next market crash or the next bull run. Pick your strategy, stick with it, and let time do its thing. Because 10, 20, 30 years from now, you'll look back at those early dividends. The ones that barely covered a dinner bill, and smile, knowing they were the first bricks in a financial fortress that changed your life. You were never just investing money. You were investing in freedom, the freedom to live life on your terms. The best time to start was yesterday, and the second best time is right now. Future you is going to be very grateful you did. If this helped you see investing in a whole new way, subscribe and drop a like to help others find it. Leave a comment sharing how you're building your dividend strategy. I'd love to hear your approach.